Good morning. It's Thursday, the 4th of September, and this is Govindraj Ethiraj broadcasting and streaming weekdays from Mumbai, India's financial capital. And we're not seeing so much rain now. Let's see how the rest of the week holds. Our top stories and themes: global bond markets are wobbling again. India gains in anticipation of goods and services tax rate cuts. Why gold prices are set to rise further. India's services sector continues a strong run, hits a 15-year high in August on new orders and rising output led by international demand. Why Indian apparel companies may have little choice but to go multi-global location. New oil finds in South America are bringing in fresh supply in the face of new shifts in demand and global oil supply.
This is a call report with Govindraj Ethiraj.
Global bond markets are wobbling. The markets are now already run up and created a bottom of sorts thanks to the expected cuts in goods and services tax rates, some or all of which we should start seeing maybe even this evening if all goes well at the GST Council meeting that's on right now, which is also the problem. If the rates are a disappointment in any way, including for some specific sectors as opposed to what they were expected, we may see some pullbacks in stock prices. Take away the GST rates, there is no real market trigger right now, and most macro signals, including a higher than GDP growth rate of 7.8%, thanks also to a changed deflator that's in the latest quarter, good monsoons, and a relatively stronger rural demand, all of that is priced in. So yes, much is riding on the GST rate cuts, which India's Prime Minister Narendra Modi announced on August 15th, Independence Day, as an upcoming Diwali gift, and that's at least for the next few days. Diwali is on the 21st of October. On Wednesday, the benchmark indices closed higher thanks in some part to metal and pharmaceutical stocks. At close, the Sensex was up 409 points to close at 80,567. The Nifty 50 was up 134 points to close at 24,715. The broader indices were also up. The Nifty Mid-Cap 100 was up 0.69%. Small Cap was up about 0.9%. So the rupee was also on a slightly stronger wicket on Wednesday, even as most Asian currencies were weaker, thanks also to a weakness in the dollar index and, of course, back home, a strong market, that is stocks. The currency closed at 88 rupees 7 paise. That's up 0.1% from Tuesday's close of 88 rupees 15 paise. It hit an intraday high of 87 rupees 99 paise before going below the 88 mark, according to Reuters, which added that the rupee is amongst the worst performing Asian currencies this year and had hit an all-time low of 88 rupees 33 paise per dollar on Monday. Meanwhile, global bond markets are wobbling once again, as we said, in an international bond sell-off abated after a run-up in benchmark borrowing costs fueled by concerns over government debt levels, according to the Wall Street Journal. Moves have been more measured this week, but on the long end, Japanese debt is at a record premium. The US 30-year yield is back at 5%, and many European bonds are at multi-decade highs, according to CNBC. In the latest moves, that's Wednesday morning, the 30-year Treasury yield pulled back after hitting 5%. And then in Europe, yields on longer-dated debt stabilized after hitting, again, decade-plus peaks in the previous session. Uncertainty around the Federal Reserve's future independence and what this means for inflation and interest rates has added, or rather provided more jitters to the US markets, according to the Wall Street Journal. And here's a message from a sponsor. Want smarter investing at your fingertips? With InvestingPro, get real-time market data, custom alerts, and global financial insights all in one place. Join 46 million users already making sharper decisions. Download InvestingPro today. More details in the link below. What's keeping gold prices up? So gold and silver are back at record highs. To recap, gold prices hit a record $3,352 per ounce on Tuesday, extending a rally that's now taken gold up 90% since late 2022, according to Reuters. So going forward, the cues for prices remaining where they are or rising are quite strong. Central bank purchases and strong investment demand, visible inflows into physically backed gold exchange-traded funds are the key drivers, says this Reuters report, which pulls in data from a host of sources, including Metals Focus and the World Gold Council. Of course, there is this overall uncertainty thanks to the new US tariff policy approach, which is obviously good for gold. Annual net purchases of gold by central banks have now crossed 1,000 metric tons each year since 2022, according to Metals Focus, which expects them to buy 900 tons this year. That's twice the annual average of 457 tons in 2016 to 2021. That's the 5-year period from 16 to 21. Moreover, many countries are seeking to diversify from the dollar. And also, official numbers, according to, or rather reported to the International Monetary Fund, only reflect about 34% of 2024 total central bank gold demand estimate, according to the World Gold Council. That's the central banks have contributed 23% to total annual gold demand in 22 to 25. That's the last 3 years, double the average share recorded during the 2010s. On the other hand, demand for gold for jewelry, the main source of physical demand, fell 14% to 341 tons in the second quarter of 2025, the lowest since the pandemic hit the third quarter of 2020 as high prices deterred buyers, once again according to the World Gold Council, quoted by Reuters. So high prices usually lead to demand falling, and most of that happens, or rather is triggered by the big markets of China and India. There has been a shift in appetite for different products in the retail investment market, but total purchases remain robust. Investment demand for gold bars rose 10% in 2024, while coin buying fell 31% according to the World Gold Council, which said the trend is extended to this year, according to that comprehensive report from Reuters. Service sector high. India's services sector hit a 15-year high in August on new orders and rising output led by international demand. The HSBC India Services Purchasing Managers Index, or PMI, was up to 62.9 from 60.5 in July, according to S&P Global data released on Wednesday. The reasons for this is demand buoyancy, efficiency gains, and greater inflows of new business. And this was, of course, the strongest growth since 2010, according to that report. New orders grew in August for the 49th month in a row and the fastest pace in more than 15 years. HSBC analysts said that the broad-based expansion in international sales bolstered overall demand, which prompted Indian services firms to hire additional workers, and reflecting higher labor costs and robust demand conditions, both input and output prices increased substantially in August. According to that report, export orders also rose at the third fastest rate since this question was added to the survey in 2014, that's 11 years ago, with higher demand coming from clients in the United States, Europe, and West Asia. Apparel stories. India's apparel industry is amongst the handful of sectors that is facing the worst brunt of the slapping of 50% tariffs by the United States on India's garment exports. Even if the 50% were to go back to 25%, things would not be much easier given the high cost structure for most apparel makers, more so small and even big too. India, of course, is now at a tariff disadvantage as well compared to other countries in the regions who are competitors and on whom the tariffs are much lower. Indian companies have to bet on multiple locations for manufacturing, as some already are. Prashant Agarwal, co-founder of consulting firm Wazir Advisors and a former textile industry man, told my colleague Katya Naidu on the sidelines of the Elara India Dialogues 2025.
See, one of the important trend will be that one has to be nimble and flexible. In today's world, you should be flexible enough to change your buying country or brand from one to other. You can't be dependent on one. So this is one trend which people have come across. The other is the regional cooperation will increase, because when you are regionally cooperating, again supply chain becomes more agile from that perspective. Third, people have understood that manufacturing competitiveness is important. So you have to set up first good factories of scale. Second, you have to be present in multi countries. That's also a very important trend. That first you have to develop a strong base in your own country. Then after that, in certain times, you should be able to supply from some other base also. Diversification, maybe somebody is in India should also have factory in Indonesia, Bangladesh, or Vietnam, or Cambodia, or Egypt. These are some of the destinations where even buyers are saying that you are a credit-worthy suppliers. Let's be more diversified to be able to supply. And it gives buyer, the brand, more flexibility to stick to you in these times. Otherwise, if suppose I am trying to shift some of my orders to Bangladesh in tough times. So that will be considered as transshipment. But if you have your own facility, you can be supplying from their side. So I think this is something you have to rethink. So I think you have to go on the drawing board and work, because world order is changing post 2025. So world order does not remain the same.
Lastly, if you had to give an outlook, how would it look like?
So I would say, because, just to give you a perspective, we have worked a lot in Africa also. I see Africa, while Bayer wants to develop, they had always duty advantage under AGOA, but they are far behind in terms of how they will develop the competitiveness. So today, the competitiveness will be more within the ASEAN region, which we have to see within selected countries. So I think if you are a competitive manufacturing, that's the way to go. And for future lies with those who are able to develop scale. Maybe you have larger number of factories, but you are able to develop scale, have better product mix, are able to give more services. For example, a lot of buyers are talking about vendor managed inventory. But if you have that setup, then only you are able to, because buyer wants to focus more on consumers, how he is able to sell more. If he grows more, he will give you more orders. So I think supply chain, what you have to do as your main responsibility are getting well defined. So I think you have to work beyond, and with AI coming, with digitalization coming, these things become easier. So you have to get into smarter factories. A lot of AI and digitalization is coming in garment industry also.
Lots of oil. Oil prices fell about 2% on Wednesday ahead of a weekend meeting of Organization of Petroleum Exporting Countries Plus producers that's expected to consider another increase in production targets in October. Brent crude was down over $1 to $67.98, so it's now under $68 a barrel. That's on Wednesday afternoon. 8 members of the OPEC Plus will consider further raising oil production at a meeting on Sunday, according to sources who spoke to Reuters, as the group seeks to regain market share. While this is where things are right now, overall supply conditions are looking good for oil in the near future, with new finds and some demand shifts. So what could that mean for prices, of course, and consumption? At the Elara India Dialogues 2025, I caught up with Paul Hickin, Editor-in-Chief of Petroleum Economist in Mumbai, and I began by asking him how he was seeing some of the big finds, particularly in South America and the other older fields, and how they were performing.
Paul, thank you so much for joining me. So there's a lot of new oil being discovered around the world, including in South America, where, again, there's fresh investments coming in. The big giants have stepped up their own on-ground investments there. There's oil fields being explored and potential discoveries off the east coast of India as well. But I'll come to India in a bit. So what's happening? I mean, are we seeing now globally a new wave of oil discoveries?
What I would say is we've actually seen a lot of decline in actually a lot of these things go in waves. We've seen a lot of decline in sort of upstream in some ways. The UK has been in decline. There's been, in some ways, India's been in a slow decline as well. And even US now is sort of the whole heyday of US shale. That wave seems to have at least slowing down, and it's not the same as it was. It's much more mature basin in the Permian and elsewhere. So I think there's actually been a sort of a slowing down in the trajectory of actually new discoveries in many ways. And what you've seen now is, yes, Guyana has been a big new fresh wave. And the geology there, I think it's all about the geology. And a similar geology is also in some parts of Southern Africa. Namibia is also a big area where they're seeing first oil around maybe 2030 and around that sort of what's called the Orange Basin. So I think there are new discoveries. I think these things come in waves. UK was nothing. Then also in the 1970s, there was big discoveries, and now it's in a slight decline.
When you say UK, you mean the North Sea?
North Sea, yes, sorry. Yeah, the North Sea. So you see the North Sea, there was big discoveries in the 1970s, and now that's been almost maxed out, and there's a decline. The same things with even US shale. The sweet spots are starting to be fully exploited, and now there's a kind of maturity in the US shale plays now. So we're seeing these things go in waves generally. you could argue necessity breeds mother invention. So there's kind of this idea that maybe that people start looking elsewhere, that there's more of an interest in Africa's always been a big frontier play. There's always been the hope of discovering more. And we're seeing some breakthroughs. Indonesia as well. There's been seeing some big interest as well. So people are looking further afield. I think there's new technologies are coming to look further in deep water, for example, bigger breakthroughs in deep water, which is what you're seeing through the Gulf of Mexico / America. So there's actually better technology now, better ways of finding some of this oil as well. So it's technology, it's companies shifting away from maybe the easier finds as the shale patch starts to kind of reach maturity. So it's kind of a lot of things going on there.
Right. And how do you see this in the context of overall global oil production right now, as well as projected in the next couple of years?
Yes, that's a good question. So I would say that what we're seeing right now is actually that we are kind of in a trickier phase for supply. Yes, the Americas are still big on growth. Brazil, like I mentioned, Guyana, Canada, and the US. We're seeing US where prices are around WTI, around the $60 barrel mark, where it starts to affect break-evens and starts to affect production. We're seeing a huge slowdown in US production, especially in the shale. Deep water has long cycle investments seem to have their own logic and economics which keep them going. But shale is a bit more of a marginal producer that can be slowed down. And we're starting to see that on terms of function of price. But realistically, Guyana, Brazil, others will continue going. And I think you're still going to see 1 million barrels a day of supply growth, especially coming from the Americas. So I think that's the big story across the Americas. Elsewhere, it's looking less convincing, I would say. Even when we talked about Africa and Namibia, that's not till 2030. So that's some way off. So some of these discoveries, so some of that areas. And there could be more breakthroughs, but the Americas is where the real growth is for the next few years.
Right. And going to come to the demand side in a moment. And India too has been looking at the Andamans, for example, or off the Andamans, and sees that as a potential find. What's your sense from your vantage point?
Yeah, so I think what India have done is it's been very positive. They've really, under Mr. Puri in the last few years, they've really tried to incentivize and encourage exploration, the upstream side. They've got new licensing rounds, new incentives they're trying to encourage international players, BP, Petrobras. I was at Indian Energy Week, and these were the big companies signing deals. There's clearly interest to using the expertise from outside. Like I was saying, the new technology is helping to find new oil, find new plays. So there is actually a real optimism, and there's been some small hope, positivity coming through that. Yes, India's upstream has been in a bit like the North Sea. It's been a bit in decline, and they're trying to reverse that. I think they've got more possibilities than North Sea to reverse it, but still, it's a tricky game to find the oil. But I think there's some confidence that more oil will be discovered and found, though.
Right. Just come to the present. How are you seeing the current state of the market, both now in terms of supply? I mean, I think you've given us a longer-term sense of supply, but current market in terms of supply and demand.
Okay, so if we talk about supply quickly, I mean, again, Americas is still the big driver of growth this year and next. That's the big chunk. And then you've got the question marks really still over US production, because there was a big expectation at the start of the year that US would still grow quite significantly. That growth is probably not going to materialize. We may see a couple of 100,000 barrels a day over this year, but not much more. It could even be flatlined, so it could even be a bit of a decline in the second half of the year. So depending on where a function of price. So that's the big question. Probably see about 1 million barrels a day of supply overall. And then you've got demand, which there's a big uncertainty on the demand side. You've seen IEA saying 0.7 million barrels a day. You've got OPEC saying 1.3 million barrels a day. Truth is probably somewhere in between. Still a lot of uncertainty over China and China's economy, although it's still buying a lot of oil to fill up its SPRs. And then you've got the questions over US, inflation versus economic growth, what the Federal Reserve is going to do. So there's still some uncertainty about that demand picture as well. But if those two things were to play out across those uncertainties. Probably looking at things fairly balanced. So then the question relies on OPEC Plus and what they're going to do. Are they going to pause to the end of the year, or are they going to continue bringing back the barrels? The likelihood is they're going to take a wait and see approach and see where prices are. Although OPEC doesn't target prices, obviously it's critical to their thinking, and they won't want to see oil prices drop below $60 or too far below 60. So I think the OPEC question will be hang over the market if we see prices starting to drop further below, out of the 60 to 70 range into the 50 to 60 range.
So the elephant in the room, so to speak, is Russian oil. Now, at this point of time, America is putting pressure on India to stop buying Russian oil. Roughly more than 35% of India's oil imports are coming through Russia right now. This was obviously much, much less before Russia's invasion of Ukraine. Now, my question is, if, let's say, India were to not buy so much Russian oil or cut down drastically, what happens to the market?
That's a great question. In that scenario, then probably some of the Russian oil will go to China. China would probably buy more, but it probably couldn't take everything. Then the question is, realistically, what happens? Some of the oil might find a way, if they sell it cheap enough, to other places. There's always ways of the oil going through the dark fleet and navigating those sanctions. But at the same time, the dangerous scenario is that prices would spike. If not all that oil was to find home, then the risk is of a spike in prices, and that still could happen. Yes, there would be, OPEC has roughly 4 million barrels of their spare capacity, mostly in Saudi Arabia and UAE, and those OPEC could quite quickly bring back barrels to try to mitigate any kind of spike up until a point, and that would probably allow time to negotiate or get some wiggle room, because Trump also won't want prices to spike. So there's a lot of moving parts there, but I think politically Trump won't want prices to spike, so he may change tack. And obviously there's that 4 million barrels of their spare capacity that and OPEC could unwind quickly and bring back all those barrels, especially Saudi Arabia and UAE.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.